In this example, which is on 1st of April 2018, a company which uses the dollar as its functional currency, buys goods from an overseas supplier who uses pounds as its functional currency. Okay, so the direct company over here is a company who's purchasing goods from an supplier which is overseas, and the direct itself uses dollar as its functional currency. That's the currency in which it is operating, and the overseas supplier, that supplier is operating in pounds. Now the goods are priced at 54,000 pounds. Payment is made 2 months later on 31st of May 2018. And these are the exchange rates what have been given to you. On 1st of April, $1 is equal to 1.8 pound. So basically dollar is a stronger currency over here. And on 31st May, when the payment has been done, at that date, the exchange rate is 1.75 pounds to $1. Okay. So now the question requirement is to prepare the journal entries for each of the transaction. That is at the time of purchasing the goods as well as at the time of making the payment, right? So now, uh, in this case, okay, so you see that whenever a company is doing a foreign currency transaction, they have to translate it at their own functional currency, right? So the invoice amount is 54,000 pounds. So I'm going to convert it into dollars. So for that, it will be 54,000 divided by 1.8, because as I told you that the dollar is a stronger currency, so you need to divide over here. So 54,000 divided by 1.8, I guess it will give you around 30K, 30,000. So that's $30,000. Okay. So in the books of Derek, it will be recorded as debit purchases with the amount of 30,000, and credit will be your accounts payable with the amount of 30,000. Yeah. Now that's the transaction which you have to record at the time of purchasing the goods. This is a transaction which direct company will record. On the other hand, when the direct company is making the payment, which is basically after 2 months, uh, we would need to see that what's the spot rate or the exchange rate at the date of payment. So in that case, it is 54,000. The rate is 1.75. So if I convert it into dollars, it will turn out to be 54,000 divided by 1.75. So it will be 30,857. So basically, Derek has to pay more, like what was initially been recorded in the books at the time of purchasing, right? Now you have already recorded the payables at 30K. So at the time of the payment, what you have to simply do is you have to remove the liability. So the liability will remove on the debit side. So I'm going to write down accounts payable debit with the amount of 30,000, and but the credit over here is cash because you're making the payment cash or bank. So the bank would be credit over here at 30,857. Now because you have paid more, this is called an exchange loss, a foreign exchange loss over here, which has to be recorded in the income statement. Okay, so there's a balance on the debit side, and I will write it down as foreign exchange loss with the amount of 857. So this will be recorded in the income statement. Okay. So now moving on to the next example, assuming that the payment is not made after 2 months, right? And is still outstanding at the reporting date, which is the end of June, 30th June 2018. And at that date, the exchange rate is 1.9 pounds to $1. Now, you need to understand the concept of monetary items and non-monetary. Monetary items give you a right over cash basically. So, like your receivables, your payables, your loan, uh, a right to receive cash or to deliver cash. So, it can be your cash, receivables, payables, loan, all of them are considered to be as a monetary. But other assets, the non monetary, they don't give you a right to receive cash or to deliver cash, which is like your property, plant and equipment, land and buildings, intangible assets, and these inventory. So they don't give you a right to receive any cash or to deliver a cash, right? So in that case, if it's a monetary item and if it's unsettled, like in this case, the IS 21 rule says that you have to retranslate it at the year end. Okay. So now initially we recorded purchases debit and payables credit. So I'll just copy this transaction back again over here. Okay. So that's your initial. Now purchases is basically your inventory. So this rule doesn't applies on the inventory, okay? But on accounts payable, because this item is considered to be as a monetary item, and as it is unsettled at the year end, I mean still the balance of liability accounts payable of 30,000 is still remaining in the accounts. So I need to retranslate this at the closing year exchange rate, which in this case is 1.9. So 54,000 divided by 1.9. So this will give me 54,000 divided by 1.9. It will give me 28,421. Now, what's happening is that your liability has reduced down in its value, okay, from 30,000 to 28421. So this has been a reduction of 1579 in the liability because of the exchange rate movement. So this will be considered to be as your foreign exchange gain, and it will also be recorded in the income statement. So what I'm going to do is that I'm going to reduce my liability. My liability has gone to 28421. So first I will find out the difference, which is from 30,000. It went to 28421. So this gives me a difference of 1579 pounds. Oh, sorry, dollars. Okay. And so debit would be your accounts payable because now I have to reduce down its value. And this reduction of $1579 will be considered to be as your foreign exchange gain. And this will also be recorded in your income statement. Okay. Now, in the third example, on 1st of January 2016, the XY company, a company that uses US dollar as its functional currency, buys goods from an overseas supplier. So in this case, you have one company, which is XY company, operating in the US and it's trading in US dollars. So that is considered to be its functional currency. Whereas the other company, which is an overseas supplier for XY, is operating in a country where dinar is the currency which is used to carry out the transaction. The goods are priced at 35,000 dinar. Payment is still outstanding at the reporting date. So in this case, it's not a settled transaction. It's considered to be as an unsettled transaction. So at the time of the initial transaction, okay, again, it's 35,000 dinars. So you need to convert it into XY company functional currency. So I'm going to take 35,000 dinar divided by 1.75. Again, dollar is strong over here. So we'll take $35,000 divided by 1.75. So it turns out to be 20,000 US dollar. So when I have to record the initial transaction, it's going to be debit purchases with the amount of 20K, but credit would be your accounts payable with the amount of 20K. So purchases itself will go into the income statement at 20K, but your accounts payable, as it is an unsettled item, you have to retranslate it back again into the at the closing rate, which is at the year end. And you will see that if there is any difference in the liability, you have to treat it as a foreign exchange gain or loss in the income statement. So in this case, for example, again, I have to retranslate it 35,000 divided by the rate at the end of the year is 1.92 dinars to $1. So 35,000 divided by 1.92, you get 18,229. So again, in this case, your liability has gone up. So, sorry, your liability has gone down. So there would be an exchange gain. So I need to find out the difference, which is 20,000 minus 18,229. So that will give me 1771. Okay. And what I have to do is now I have to record a gain over here. So for that, I'm going to reduce my liability. So I'm going to say debit accounts payable with the amount of 1771. Okay. And credit would be again foreign exchange gain, and that will be recorded in the income statement. Okay. Hope this question is clear. Now, moving to the next question here. Okay. So XYZ company has an year end of 31st of December and uses the US dollar as its functional currency. So this company is operating in the US dollar. That's their currency in which they are functioning. So that's their functional currency. On 25th of October, the company buys goods from a Swedish supplier for Swedish krona 286,000. Okay. So now, like these are the exchange rates given to you in the question. Show the accounting treatment for the above transaction if a payment of 200,000 is made on 16th of November. And at that date, you have the exchange rate also. Okay. Or the full amount owed remains outstanding at the year end. So that remains unsettled. But in this question, what's happening is that certain amount has been settled and the other amount of 86,000 remains unsettled, right? So what we're going to do is see, I would advise that you make up a sort of a table over here to figure this thing out. Okay. Something like this. So here you have it in terms of uh, foreign currency. So just, okay. So here is the narrative, what you will write down. Here it's in the foreign currency, which is SWK. Here is your rate, and here is the dollar, the domestic home currency, right? So now what we are going to do is, okay, so you purchase goods. XYZ company purchase goods of 286,000. So you have your purchases over here with the amount of 286,000 in foreign currency. The rate at that time is 11.16. So 286,000 divided by 11.16. Again, I'm dividing because dollar is strong. So 286,000 divided by 11.16. So you get 627. Okay. And then you have a cash payment over here. Okay. So that cash payment, what you have is around 200,000. So at that date, the rate is 10.87. So 200,000 divided by 10.87. So it turns out to be 18399. Okay. So now the remainder balances, you can just leave this one line over here. And what I'm going to do is that this is now becomes your closing balance of the liability, which is 86,000. So this is the amount which is unsettled, and I have to bring it to its bring it at its closing rate. Okay, I have to retranslate it to its closing rate, which is 11.02. So 86,000 divided by 11.02. So that turns out to be 7804. All right. So technically, if you see that you had a liability over here of 25627, but you paid 25627, but you paid 18399. So the liability should have been 7228. But because the liability due to the retranslation at the year end has increased, so in this case we get here a foreign exchange loss. So 7228 minus 7804, there is a loss of 576. Okay. And that will be treated in the income statement. So now if you want to make up the entries for it, it would be debit purchases with the amount of 25627, right? Credit accounts payable with the amount of 25627. That's the initial entry when you purchase the goods. Then when you make the payment, so you will say debit accounts payable with the amount of 18399, because that's the rate when you made the payment, and credit would be bank with the amount of 18399. Okay. But then at the year end, whatever was the remainder liability, your accounts payable, which is a monetary item, needs to be retranslated at the year end rate. And that turns out to be a liability of 7804. So technically, your liability should have been 7228, but because it has increased, the increase will be considered to be as your foreign exchange loss, and that will be recorded in the income statement. So here I will say foreign exchange loss with the amount of 576, and credit will be my accounts payable. So by the end of the year, the liability will stand at 7804 in the balance sheet for accounts payable. Okay. Now, the part B of this question says the full amount owed remains outstanding at the year end date, right? So no payment has been done. So in that case, what I'm going to do is that 286,000 will be retranslated to 11.02. 286,000 divided by 11.02. So that turns out to be 25953. Okay. So your liability went from 25627 initially to 25953. So there's a slight increase, and that increase will be considered to be as a loss. So 25627 divide minus 25953. So in that case, you will get 326. So I'm going to say debit foreign exchange loss with the amount of $326, and credit will be accounts payable with the amount of 326. Okay. The initial transaction will remain same, but because no payment has been done and it remains exactly the same balance, so you have to retranslate it back at the closing rate, and then you have to see that if there is any difference that will have to be recorded into the income statement. So if there is a increase in the liability, we consider it to be as a loss. But in case if there's a decrease in liability, we will be considering it to be as a gain. Likewise, for receivables, if they increase, so it's a gain. But if the receivables reduces, we will consider it to be as a loss. Now, in this example 5, okay, it says an entity with the dollar as its functional currency purchased plant from a foreign entity for 18 million euro. So basically, the company which is purchasing the asset, they have a functional currency of dollar. They operate in dollar, and they're trying to buy a property, a plant, basically, from a foreign entity for 18 million on 31st May 2008, when the exchange rate was £2 to $1. Again, dollar is strong, so you need to divide, and it will become 9 million in dollars, right? Simple. So because 18 divided by 2, you will get $9 million. So I'm going to say debit plant with the amount of 9 million. Okay. The entity also sell goods to a foreign customer for 10.5 million euros on this date, when the exchange rate was this. At the entity's year end of December 2008, 31st December, both amounts are still outstanding and have not been paid. So basically, this was not paid. It was on a credit. So I'm going to say payable credit over here with the amount of 9 million. Okay. Now, plant in this case is considered to be as your non-monetary item, and this item will not be retranslated. Okay. So you have to keep it at as it is at 9, and you can charge subsequently depreciation on 9 million. However, the payable, this one is considered to be as your monetary item. And for this one, this item will be retranslated because it's been unsettled and it's a monetary item, right? So 18 divided by the rate which you have at the end of the day is 1.5. So 18 divided by 1.5, you will get 12 million. So basically, your liability went from 9 million to 12 million, and that's a loss, right? So what I'm going to do is that I'm going to say debit foreign exchange loss with the amount of 3 million. That's the difference between 9 and 12. And credit will be accounts payable with the amount of 3 million. And this loss will be recorded in the income statement. So that's how you're supposed to treat with the purchase of the plant. However, in the same example, you have another question where you are a seller and you have sold some goods to a foreign customer for 10.5 million euro. So basically, you charge in dollars, but they are in euros, right? So at that date, the rate was 1.75 actually. So what you're going to simply do is that 10.5 divided by 1.75. So this will give me in dollars 10.5 divided by 1.75. So I'm going to get 6 million. Okay. So debit would be your accounts receivable with the amount of 6 million, and credit will be sales revenue with the amount of 6 million. Now, this 6 million will be in your income statement straightforward, but this account receivable, because it's been unsettled, so you have to retranslate it at the year end rate, which is 1.5. Okay. So, yeah, 10.5 divided by 1.5. So this will give me 10.5 divided by 1.5. So it will give me 7. So what's happening over here is that your receivables have increased in value from 6 to 7. So this will be considered to be as your gain as the receivables are increasing. So I'm going to debit my accounts receivable with the amount of 1 million, and credit will be my foreign exchange gain with the amount of 1 million, and that will be recorded in the income statement. Okay. Moving on to the last example over here, which is example number 6. An entity bought land on credit for 100,000 pounds when the exchange rate was this much, 1 pound to 2.085. So basically, again, you see that your dollar is strong over here. Okay. On 1st of January 2010, and at the year end, 31st December 20. Okay, sorry. This would be as the year end 31st December 2010. The entity has not paid the supplier. The exchange rate at the year end was this much, and the company plans to revalue the land to its fair value of 120,000 at the year end. So now in this case, we are not going with the cost model, we are going with the revaluation model. So for this transaction, you need to understand that how you're going to do it. Again, as I advise you that you guys can make a type of a table over here. Okay, so see, this would be your narrative, and this is going to be in your foreign currency, which is basically pounds. Here you have the rate, and here it becomes into the dollars. So this one is extra, we're going to remove it. Okay, so now what's happening is that, right, so you purchase a land on credit. Now purchased land, okay, with the amount of 100,000 pounds, because the rate is 1 pound. They have given it to you in pounds actually. Huh? So in this case, what you have to do is you have to multiply 0.85, because as you can see that dollar is stronger in comparison to pound. So in dollars, it becomes to $85,000. So the initial entry, what I'm going to do is I'm going to say debit land with the amount of 85,000, and credit will be payable because you haven't paid for it. So 85,000 credit would be your payable. But in this case, now see, the land is a non-monetary item, so we don't have to disturb the non-monetary item. Let it be at 85. And in this case, obviously, we won't charge any depreciation because lands are not to be depreciated. However, for payable, you need to consider. Okay. So now at the closing time, okay, now, and the thing is that we have to bring it to its fair value, correct? So at the closing, we have the property at a valuation of 120, correct? Right. So 120, and the rate at that date is 0.92. So this will give me 120,000 multiplied by 0.92, so it gives me 110,400. Okay, so initially you record the land at 85, but because at the end of the year you're trying to bring it to its fair value, you're using revaluation model. So now you can see that there has been an increase in the value of 25,400. So what we are going to do for the land is we will say debit land with the amount of 25,400, and it will be credit in your other comprehensive income. Okay, the revaluation surplus, which is 25,400. So first, initially you recorded at the opening rate, which was at 0.85. So the land value in dollars was 85,000. But in case if I would have decided that I would have used the cost model, I would have kept it at 85,000. But because at the year end, I'm deciding to bring it to fair value to revaluation model. So whatever the fair value is given to you in the exam question in the foreign currency, you retranslate it at the closing rate, and that will become your dollar value. So that's where you will compare that whether it has been an increase or decrease, and treat it as per the IAS 16 rules. So in this case, you can see it's 110,400. So basically the value of the property has increased by 25,400, and that has to be recorded in the OCI and not in the income statement. However, for your payables, okay. However, for the payables, you initially recorded it at 100, 85,000, but now that will turn out to be 100,000 multiplied by 0.92. That's the rate at the end of the year. So this liability turns out to be 92,000. So the liability went from 85 to 92. So there is a loss over here of 7,000, a foreign exchange loss of 7,000, and that has to be recorded into the income statement. So debit will be foreign exchange loss with the amount of 7,000, and credit will be your accounts payable with the amount of 7,000. Okay. So I hope these examples would have clear the concept of IS 21, which is how to record, uh, you know, uh, transactions which are in foreign currency and by the companies who have a different functional currency, right? Thank you very much.